William Blair Capital Partners out with a new study this morning. The market maker performed a deep analysis on more than 350,000 Glassdoor reviews on over 90 restaurant concepts to try to get a read on employee satisfaction in the restaurant industry. And the report offering some interesting insight into how diners are retaining staff. It found that compensation is the least correlated to job satisfaction. People are weighing other stuff. William Blair's group head of the consumer sector, Sharon Zackfia, joins us now. Sharon, thanks for being here. Interesting stuff here. And let's start with that sort of big picture finding that it wasn't pay that was people's number one concern here. They had a lot of other things that have to do with quality of life. What stood out to you?
Yeah, so we've been seeing this really consistently since 2015 when we started doing this analysis, where culture and values, senior management, diversity and inclusion, those seem to be much more correlated to overall employee satisfaction in the restaurant industry. Of course, those are the tougher things to get right. It's easy to raise pay. It's tough to change your culture. But this is clearly why we see stickiness. So every year when we do this analysis, we see a lot of repeats where the same concepts are in the top 10 over and over and over again. In-N-Out Burger, a classic example of that.
What is In-N-Out Burger doing so well, Sharon?
Yeah, it's a private company. It's family run. I think because it's family run, it has a very familial element to it. They don't have to kind of strive to meet quarterly earnings targets or sales targets for Wall Street. So, I think there's a little bit less of that constant pressure that you might see for a public company. And as you can see in the top 10 list, which you have up right now, 6 of the 10 are private companies. We do see 4 there that are publicly traded, a couple of them very newly publicly traded.
Okay, so I guess the question there being really with the Net Promoter Score, that translation into customer satisfaction, if you're seeing the employees actually be confident in the relationship that they have with the employer.
Yes, and clearly employee satisfaction leads to longer tenure as well. There are a lot of positive benefits that come from having employees be at the restaurants longer, right? So order accuracy is higher, the speed of service is faster. All of these things lead to better customer satisfaction and then lead to better sales. So that's kind of the gist of why we look at this so closely, because it is a leading indicator of who's winning and who's losing in the labor markets, which is a key issue for the restaurant space.
Sharon, to just put a fine point on what you were talking about the public and private companies and the point you made that Dutch Bros and Black Rifle are newly public companies. Is being a public company and having a satisfied workforce, are those two things kind of incompatible writ large?
I think it's harder. I wouldn't say it's incompatible. So a great example would be Starbucks. And, Starbucks has obviously been in the news a lot for its employee relations. But if you look at Starbucks on an absolute basis, it's been a top 20 NPS score for the entire time we've done this since 2015, which is remarkable given that Starbucks has well over 30,000 locations right now. So scale isn't necessarily the enemy of employee relations, but it is obviously hard to stay small as you get large.
Sharon, if I read the findings correctly, it doesn't seem to have a favorable read on the CEO of Starbucks. What could they do to change that sentiment?
Now, to be fair, when this analysis was done, it was a time of transition where the prior CEO was leaving and Howard Schultz, the founder, was coming back as interim CEO. What we have seen, generally speaking, at Starbucks has been a waning in CEO approval since Howard kind of stepped away from being CEO several years ago. And we'll see what happens, as they announce a new CEO later this fall. But clearly, Howard Schultz is back as interim CEO, has a strong vision for the company, and all the expectations are that he will remain as chairman of the board. So there will be that founder-led dynamic, obviously, with a new CEO coming in to partner with the board on leading that vision.
On the topic of employee satisfaction, I wonder what the delta is or how much change there is among employees when you have more robotics that are actually entered into that workplace experience, whether it be a Flippy or a Chippy, the fry makers versus the chip makers, it doesn't matter. That's still one other piece of technology that employees are on the ground in those capacities and having to work with and navigate as well.
Yeah, you're hitting on a really good point, right? I mean, robotics are still very nascent in the restaurant space, but generally speaking, where you see restaurants get excited about robotics is when it can do repetitive, mundane tasks. I mean, all of us, not just restaurant workers, dislike doing repetitive, mundane tasks. So I think to the extent robotics become more feasible in the restaurant landscape, that will probably only serve to improve employee satisfaction, because then employees can spend more time on the things that they actually enjoy, which might be the customer interaction or the cooking of the ingredients or what have you, rather than necessarily flipping a burger.
I want to ask you also about another name that stood out to me in the survey, and that is Chipotle. Because as you point out, surprisingly low NPS score, CEO perception, employee satisfaction. And it's surprising because Chipotle's been killing it, right? Like the sales have been going along quite well. How do you sort of think about that disconnect?
Yeah, I mean, it probably is one of the most surprising findings is to see Chipotle continue to kind of trend downward in employee satisfaction. I think, with Chipotle, they went so digital during the pandemic, and, that's a different muscle memory for employees when they're serving, primarily Uber Eats drivers who are delivering the food, or orders are being placed ahead and consumers are just coming in to pick up. Now that those lines are coming back to the front of the stores again, which I think we've all seen, that's a different dynamic. That's a different level of pressure for those employees. And I think management's talked about that, right? That they need those employees to get more seasoned in understanding that kind of throughput as lines queue. But that definitely adds more stress when you have, 30 people in line waiting as opposed to just, putting orders on the shelf. And so I think we're seeing some transition there at Chipotle as their employees are adapting to kind of a more normal consumer behavior again.
Yeah, that makes sense. Sharon, thanks for your insight. Interesting stuff here. Sharon Zackfia, William Blair's group head of the consumer sector. Appreciate it.